Hey, everybody, this is Nolan Sam with Infinite Banking Radio, and I have one of my favorite people on. He's done some wonders for me and my family and our business. His name is Clay Hagler, and he's an accountant here in Birmingham. He's done an amazing job for us in our business, my wife and I's business with real estate. And I wanted to come on today and go over a couple things. First of all, introduce him and what he does, how he got into the accounting business, but go into what a lot of our higher income earners are experiencing. And they're experiencing not a lot of deductions, not a lot of subsidies. They're paying a lot of taxes to Uncle Sam. And so that's the problem that a lot of high income earners are experiencing. And Clay has some amazing, very cool solutions that can maybe help you where you are today. So Clay, go ahead and introduce yourself, man. Thanks for coming on today.
All right. Thanks, Nolan. Like Nolan said, I'm Clay Hagler. I own an accounting firm here in Birmingham, Alabama, Hagler and Brocado. We have 7 CPAs and some other accountants and office manager. I call ourselves kind of like a boutique firm. A lot of our CPAs have come from the bigger accounting firms such as Deloitte, Ernst & Young, PricewaterhouseCoopers, and so forth. And so hopefully we have some complex ideas that we learned from the bigger firms and bigger clients that now we can bring to the smaller middle-sized clients that sometimes, just to be honest with you, get left out in the cold so far as these complex tax strategies. And we've implemented a few of them with Nolan, and I think that's what he wanted to talk about today.
Yeah, so kind of go into that, Clay. So I basically got hooked up with you from another guy in our office. He said, Justin Kraft, he said, you need to go speak with Clay. He's got some really cool strategies on how to minimize taxation. And so, Clay, I'm actually rereading a book right now. It's Tax-Free Wealth by a guy named Tom Wheelwright. He's Robert Kiyosaki's accountant who wrote the book Rich Dad Poor Dad. And what a lot of people don't realize, and that you know better than anybody, is that 99.5% of the tax law is actually written to reduce your taxes. The 0.5% is actually written to work off of the gross, but all the loopholes, everything that's out there actually talks about how to lower your tax, or it's the tax law is written to incentivize entrepreneurs and business owners and investors. So can you kind of go into some of the unique laws and the strategies on what your clients are currently using, and how maybe some of our clients, the higher income earners, can maybe begin to implement some of these strategies that you're currently using with your clients?
Right, and there's a lot of those tax strategies that we put into place, but the one that I'd probably want to speak about today that we've actually helped you implement, and then also some of our other high income earners, has to do with real estate. It's a great way to invest, and there's a lot of tax strategies and a lot of incentives to help real estate market in the Internal Revenue Code. And one of those is there's when you go and buy real estate, depending on what type of real estate that you buy, there is depreciation incentives put in place, especially for multifamily, even residential rental, not quite as lucrative, but you also have multifamily, commercial buildings, and so forth. And I guess the best way to describe this is probably give you an example.
Yeah.
So let's say you
Well,
have
before you get in, Clay, I didn't mean
yeah,
to cut you off. Can you
yeah,
can you explain what depreciation is to somebody that has heard that number or that word before, but maybe doesn't comprehend what depreciation is?
yeah, sure. When you buy something tangible and it's a business asset, you get to expense that purchase of the business asset. And typically you get to just expense that over time, whether it's 5, 7, 15, 27 and a half years, or 39 years. Those are useful lives of a tangible asset, and how you get to expense that, or the time period you get to expense that over. And so when you buy real estate, typically there's 2 types of real estate: residential real estate and commercial real estate. And those 2 types of items, when you're renting it, you get to expense the purchase of those properties typically over 27 and a half years and 39 years. And so if you think about it, that's a long time for you to recoup your investment and have any tax benefits from expensing those items. But there's ways that we implement. For instance, in the tax code, you can utilize cost segregation studies, which in essence takes that investment and breaks down the residential property or the commercial property into certain components. And some of the components we can take out of those long lives of 27 and a half years and 39 years and break them down into 5, 7, and 15-year property. Now, all of a sudden, you get into these depreciation incentives I'm talking about, where those properties that fall into those useful life categories of 5, 7, and 15 can all be written off in the first year. And so that's kind of just the beginning of how real estate can kind of help you. So hopefully that's a good definition of depreciation and how we can go about this.
Yeah, yeah, no, absolutely. And I think that's one thing that I learned with real estate is the game is figuring out how to take active income, which again, our higher income earners are earning, let's say a seven-figure earnings, a salary of $1 million a year, but they're sending 400,000 of that to the government because they don't have those subsidies. So if you don't mind, Clay, give us kind of that step-by-step of what that looks like for how can somebody that's earning a high income be able to use this depreciation as a passive loss to offset against their active income. What is that? Can you walk us through step by step kind of what that looks like?
Well, and that's a your intro into it is a great. Oh no! Hold on one second.
You're good. You're good.
Um, it's a great intro into what you were discussing. One second.
There we go.
Well, I'm trying to get here, but let's see. I'm gonna move it over here.
That's all right.
If this helps. All right. Conference room is actually being taken by a client, so we're having to do this. Okay. All right. So that was a good intro because depreciation, when you have rental real estate, it is considered either active or passive. And so when you have a passive activity and you have a loss from a passive activity, you cannot take that passive loss except against passive income. Okay, so a lot of people get limited. Let me give you an example. You have a doctor. We'll just say you have a doctor that's a high wealth individual, and that doctor makes $1 million a year. That doctor likes to invest in real estate, so they go buy a small multifamily apartment. Okay, that apartment cost them $2 million, and they're getting rental income. But because of the cost segregation study I just previously spoke on, they get this huge depreciation deduction in the first year, which causes them to have a significant loss from that buying that multifamily complex. And let's say that loss is $200,000. Well, that's a passive loss. Now, all of a sudden, the doctor cannot take that loss unless he has other passive income, which they usually don't, and it just carries forward. And it might take them a long time before that they can actually utilize that loss. They don't lose it, but it's just not very much of a benefit instantaneously to them.
Right.
So somehow we've got to figure out how to get that passive loss to be an active loss so that that doctor can actually take that loss against the $1 million that they've made from being a doctor.
Right.
And so there's ways to do that. A particular example, you have to get to where that somebody within the family is a real estate professional. Okay, now the doctor's going to have a hard time being a real estate professional because I'm going to fix it. And this is all kind of building on itself, but to actually get a multifamily facility or a piece of real estate to be an active loss, if it incurs a loss because of this cost segregation study I'm talking about, we've got to have somebody that owns that property that's a real estate professional. That doctor is never going to be able to become a real estate professional, and here's why. A real estate professional has to have it has to have a few requirements. Over 750 hours in a real estate business a year, which means in transactions or just the business of real estate. Now, some doctors can say, well, I work on the weekends, I do this. I actually have 750 hours in real estate, even though I have a day job as a doctor. Well, the problem is the second requirement where it says you have to have over 50% of your time also that you spend in work also in the real estate trade or business. That's the one that becomes hard to overcome. So what occurs is the doctor has all these passive losses and they can't take them. So we've got to find a way to allow that doctor to take the losses. So typically what we suggest our clients is take the spouse. And if that spouse does not have a full-time job, is stay-at-home parent, then that that spouse can become the real estate professional, whereas they own the property, they do the work, and you kind of train that spouse to do all the real estate dealings. The other one can be involved, but that spouse now all of a sudden can have over 750 hours. That 750 automatically, if that's all that spouse does, is over 50%, and of their time is spent on real estate transactions. Now all of a sudden that spouse is a real estate professional.
Of those 750
Now,
hours, Clay, how do you quantify that?
okay, typically, you're supposed to, if this is what you're asking, the IRS states that you need to have a log where you log your hours. Now, if that's all you're doing, it would be pretty easy to generate a log if that's all you're doing, for your job throughout the year. And so, but you're supposed to have a log that you track your hours and say, hey, I have over 750 hours. This is the only thing I do. So obviously it's over 50% of your time. Now, all of a sudden that spouse is an active real estate professional. Okay. Now, what does that mean? What that means in the example I gave you, doctor makes $1 million. Spouse, it's just, they pull their money together as a family. Spouse goes and buys the multifamily unit. That multifamily unit, because of cost segregation study and depreciation, basically brings a $200,000 loss. That $200,000 loss now is active because the spouse has over 750 hours and is a real estate professional. That loss now can be offset against the other spouse's income as a doctor. Now we've just lowered your taxable income from $1 million to $800,000. Now, a lot of times the depreciation will bring even larger numbers than that, depending on what type of building it is. And so it's just a really good way to reduce the tax liability for families that like to invest in real estate.
So when you have these clients that are doing exactly what you just said, I mean, because I've experienced when I try to get my wife to go and do all these real estate deals with me and everything, and she's excited about it on paper, but then when I, try and get her to go and actually help me with something, she gets a little busy, right? With your clients that are currently doing this, where you have, again, a high income earner and the spouse is, again, being the real estate professional, have you experienced, or have you taught the client and their spouse like certain things that they can do to be in it more often than not? I mean, it looks great on paper to have that huge deduction, but it sounds good, but it's also something that we have to like do as well. Do you have trouble getting people to take action on that, or what's your experience in that?
Well, you do. I mean, that's a good point. And there's really no other way around it, unfortunately. For you to be a real estate professional, you have to actually have the hours in there. So the spouse is actually going to have to get involved.
Yeah.
Whether they like it or not, because if the IRS were to audit you and you can't prove that, then of course it would be denied. Now, when you can convince the family, when they sit down, hey, how vital this is for the spouse to actually take a active participating role in the real estate, I think the way that you convince them to do that and let them understand is they'll show them on paper how much taxes it's going to save. And once they see that, then they start saying, oh, well, if I save that, we could buy this, or this could help with the kids' education, or we could invest in another life insurance policy, whatever it might be. Now, all of a sudden, it really garners some attention, and hopefully it motivates them to go forward and actually make it come to fruition.
Yeah, you made a good point. So one other question I have too, Clay, is the depreciation deduction, or the bonus, or the accelerated depreciation, however it's worded. That's you buy a building, and you can take the depreciation over the remaining, 39 years, but that bonus depreciation is in that first year, and the real estate professional status, you have to renew each and every year. How are your clients? Because in my opinion, I could be wrong here, but a lot of accountants, their focus is lowering taxes, this particular year, right? Whatever year we're in, 2022, 2023, we have to lower your taxes this year. How are your clients positioning themselves to not only lower their taxes today in today's situation, but also into the future?
Well, I mean, there's a lot of different ways that you can do that. Of course, that is the ultimate goal, is like, hey, what can we do today to lower taxes? Because, it's the time value of money. If we can lower them today, so then you can take the money and invest in something, whether it's more real estate or uh, some type of investment like that you're really involved in, the whole life insurance, because you can put money into there and it gets tax deferred growth. Any of those type of mechanisms is going to let your money grow without paying taxes in the future. One way we see, and I'll give you two examples. Somebody buys a piece of real estate. Well, they can then now, instead, if they have a huge gain, because they're going to sell the real estate for a profit in a couple of years, and they've already taken all the huge cost segregation expenses because of the depreciation incentives and already saved the taxes. Well, they're thinking to themselves, well, if I sell this now, I have a bigger gain. I'm going to have to pay tax on it within 2 years of my savings. Well, you could do a 1031 transaction, meaning roll it over into another property and defer the gain, and continue to do that over and over again, especially if, in my example, you have a spouse that's making, in my example, $1 million a year. You can live off that $1 million, where you continue to just defer the gain down the road by doing 1031 transactions. And so it's just letting your money grow and grow and grow. Also, you can, like I said, buy whole life insurance as it continues to grow, tax deferred, as well, with the dividends you're getting from the life insurance every year. And as that money grows in the life insurance, as you, I'm sure, have told all your listeners, you can pull that money out as a loan and go buy more real estate, and you still get your dividends over the years.
Sure. And one thing too that Clay, that you mentioned, is that people don't really realize this, but when you pay taxes, you're not only the money is not only gone, but you've now given up the ability to ever earn on that dollar again. It's gone, like you said, the time value of money as well. So if we can distill it down, then basically the whole goal with this is to figure out a way to, obviously, when we have these high income earners, we need to go buy real estate, whether it's multifamily, whether it's commercial. Like you said, there's still some incentives with single family, but the majority of those deals, we can take the really large depreciation deductions on larger properties, whether it's through a syndication or whether they're doing it themselves. But basically buying big buildings of real estate and having that big bonus depreciation through that cost segregation analysis, which will then lower their taxable income, saving them more money, putting more money in their pocket, as long as them or their spouse is a real estate professional. And so is that something that you guys at your office that you guys can do? Because again, I get calls every single day of people looking for an accountant exactly like you, and someone that's knows the tax law like the back of their hand, works with investors and entrepreneurs. When somebody calls me and asks me, tell me more about how I can get them in touch with you and what your business does.
Yeah, we do, and we got our start with a bunch of real estate clients, so it's very familiar to us. It's one of our passions, and so we really like that part of the tax code. It's kind of what we grew up on. But yeah, so I mean, if they call us, I mean, they can contact you, and then I mean, you can get us into, shoot them an email or get them in touch with me, and we'll be glad to talk about their situation and see if we can help. And we'll be glad to take a phone call, and sometimes we can help, sometimes we can't. We're going to be real transparent and honest with you and just say, hey, you got a situation that I think we could implement some of these strategies, or we'll also tell you, it's like, hey, I don't think you'll meet the real estate professional requirements, and we might need to look at some other ways. But we'll definitely try to motivate you, because we really like this idea.
Yeah. And I know that, your time is valuable. I know it's a lot of fun when you and I go to lunch and we say, hey, I have another client that just saved, $80,000 in taxes. And it's a lot of fun when you see when the tide raises all ships and everybody gets a chance to win. So, but yeah, Clay, obviously this is Clay Hagler. He's an accountant in town and an absolute rock star. Has been an amazing asset for my family and my business. And so, but yeah, that's basically the whole story, guys, is we're just trying to figure out whether it's you and your spouse to become a real estate professional. You go buy real estate either by yourself or through a syndication. And then we're going to take this bonus depreciation deduction that's going to lower your active income, putting more money in your pocket. So Clay, do you have any other closing thoughts before we get out of here?
No, just y'all got a good advocate in Nolan. He does a great job and really cares for you guys. I've seen it. So that's all I would say, and we'd love to help.
Awesome. Well, Clay, again, man, thanks so much for your time. I appreciate you being on here today. Talk soon.
Okay, thanks, man.
All right.